Right, let's go.
Okay, the monetary policy checklist. And as those of you who have been watching it in the past, it's a range of economic indicators and it's using the hard data to see whether they influence the Reserve Bank to tightening, neutral or easing. So GDP. We know that in the last 3 quarters, GDP has slowed from 0.9 to 0.7 to 0.5. GDP is slowing, so that's in the neutral camp. Don't need to hike, don't need to cut.
So just on that, 0.5.
0.5 is the last quarterly growth in GDP.
It indicates an annual run rate of what?
It's 2.7 was the run rate.
Yep.
We're talking about trend GDP. That's about the sort of, again, the Goldilocks. If we could grow the economy at 2.7% every year for the next 10 years, we'd be happy. But of course, there's a cycle.
Yep.
So it's a good result. That's why it's neutral. You don't need to hike to get it slower. You don't need to ease to get it stronger. So it's in the neutral camp.
Yep.
Inflation. Yeah, that's our bugbear. Yep. As we're saying, inflation's high around the world. Even though it's coming down, it's still way above the target.
So the last quarterly inflation read was what, Steve?
It was 7.8 was the quarterly read.
That's for the December quarter.
The monthly read, which was for January's down to 7.4. So it's moving in the right direction. Remember, critically, absolutely critically, the target for the RBA is between 2 and 3. Here we are talking 7s.
Yeah.
We've got a long way to go.
Yeah.
Labour market, I'm going to put that into, well, between neutral and tightening because unemployment's very low. And even though we just discussed the wages side not being an issue, there's still a risk that if the unemployment rate stays at this very low level that we'll get some wage pressures. So that's sort of in between neutral and tightening. Actual wages, as we just discussed, neutral. You don't hike or cut because of that. International economy, I'm going to put that into easing. The world economy is very weak right now. The chatter about the US, Europe is recession. Whether we get there or not, it's, in a sense, doesn't matter what label you put on it. Growth's going to be very weak.
So, but the UK government, the UK Chancellor of Exchequer said they don't expect there to be a recession in the UK as late as yesterday.
Yep.
But yeah, you worried about more about Europe and US.
Europe, US, and even China, with its reopening from COVID a couple of months ago, hasn't really had that, uplift that we wanted to do. They're a major trading partner. Yep. We want China to be strong, so they buy lots of our iron ore and all of our other products. So, but the international economy is pretty weak and weakening. Right. And remember that, just as we in Australia are experiencing the impact of these rate hikes, so too are people in America, in Europe, in the UK.
Except you might just touch on, just quickly on that, because that's an important point you just raised.
It is.
The US is largely a fixed rate economy, and the speed at which rate increases affect the US is much slower than what happens here in Australia.
Indeed. Most of the mortgages there are fixed rates and long-dated fixed rates. They're 30-year mortgages. Can you believe it? Whereas here in Australia, we're predominantly variable with our fixed rates generally only being 2 or 3 years. And that's, of course, this mortgage cliff issue that's unfolding before our eyes as we speak.
So that is a big difference for us relative to the rest of the world.
So, and that's another reason why we don't have to hike. Well, another reason why we probably don't have to hike as much as the rest of the world.
Yeah.
The RBA hikes, 350 basis points. That impacts mortgage holders very quickly. The Fed hikes 500 basis points. It trickles into the mortgage system slowly. So
only usually for new borrowers.
For new borrowers, yes. So they have to do a whole lot more to achieve the same result as our friends down at Martin Place.
We're sort of lucky in that regard.
Correct. Variables are good. The predominance of variables are a good thing in Australia. It makes monetary policy work a little better.
Yes.
House prices, I'm going to put that as neutral. Core Logic have got house prices lifting in the month of March. Whether that's just a noisy blip, I don't know, but the RBA would neither be happy nor sad with that. They've already come off 9% house prices, so that would be neutral. Retail sales, weak. We know that the volumes in the December quarter were down. I was looking at, I think it was ANZ, they look at their credit card and transfer payments to the retail sector. It looks like that in March, it's going to be a big negative. We consumers, we're not silly. We're responding to higher interest costs. We're responding to cost of living. We're spending less. We're sitting at home, cooking at home rather than going out for dinner sort of thing.
And by the way, the next point, the bullet point, will probably tell us the reason why.
This is the reason. Consumer sentiment. My goodness, we had both ANZ and Westpac releasing their consumer sentiment numbers recently. Both are near historical lows. And the other thing, Mark, which I find really hard to believe, but it's a fact, consumer sentiment today is worse than at the worst point during the COVID lockdowns. So when we were locked down a couple of years ago, businesses were shut, we were stuck at home, worried about the health. That was a scary time, I have to admit. Consumer sentiment obviously fell. Now it's weaker, which goes to show, to me anyway, that cost of living, interest rate hikes, uncertainty about, we've got house pricing, I've lost some wealth. The stock market's pretty poor at the moment. People just don't have that confidence.
I don't feel rich.
There's a cash flow effect. So consumer sentiment, is it a good time to buy a household item? No. Consumer sentiment's very weak. Building approvals, again, I saw the numbers come out a couple of weeks ago. No one's building anymore. House building approvals have fallen. Building companies are going belly up. Not all over the place, but frequently enough.
Well, it's a massive increase of building bankruptcies in the last.
Correct, because their fixed rate contracts have seen them be underwater because, as I was saying, the cost of lumber and steel, let alone getting a tradie to sort of put the electrician and the plumbing and all that sort of stuff. So building approvals are weak. Good news is business investments were strong.
I don't understand this one.
Well, and it came through the NAB survey just recently. Yeah. The business sector is downright optimistic about the economy.
I just don't.
So consumers are gloomy as can be. The business sector, look, I think.
How do you reconcile those two things?
I think I reconcile the business sector with the links to our mining sector. Iron ore is still $125 US a ton. And even though, you and I don't export iron ore, the spin-offs into the companies that manage the cash flow, that manage the workers, that manage the machinery and equipment that's needed.
Bill Evans just called it the prosperity dividend.
Correct. And so that actually has an impact on the business sector. And so I suspect it's linked to the export sector doing pretty well. And I think there's also this, what do we call it, a hangover from COVID. During COVID, a lot of businesses shelved their projects to ramp up their IT spend or to build another warehouse or whatever. Well, they couldn't do it. We were all locked down, or they couldn't actually get the machinery. So when businesses are now saying, now that we're living with COVID, they're saying, oh, gee, I actually do need that IT equipment. I need to build that warehouse because I'm selling more stuff through the warehouse rather than bricks and mortar retail. So the business sector's doing pretty well. We consumers are the ones that are getting hit with these interest rate hikes. And that feeds into the business confidence, which is nice and strong. Commodity prices, they're neutral. They're down a bit from where they were 6 months ago. But as I said, iron ore's high. Oil price is down, which is good for inflation. But, the RBA is not going to be putting up rates or down rates because of commodity prices. Stock market's weak. Again, I'll put that just between easing and neutral because the stock market's down on the back of the banking concerns and rate hikes and the like. And current rates,
just on the stock market, what's interesting about that before you go into current rates, Steve, is that in aggregate, what we've got to remember is the contribution of what banks contribute to the total ASX, All Ordinaries Index, is quite significant.
Yes.
So there are some people in the stock market who are killing it. Like they might have a lithium mine or something like that.
Yes,
they're doing
exactly,
very well. But the banks dominate in our stock market at least such a big percentage of the total.
Correct. And the fact that, as we were saying before, the bank stocks in Australia, while they're down about 10% roughly because of just a bit of market sentiment about what's happening.
But there's also margin shrinking too. Because,
indeed, the rate hike
because they've all got to pay back
economy.
This TFF.
Yeah,
they've got to pay it back.
Correct.
And now they're raising money at 6.5%
instead of 0.1.
Yeah,
yes.
correct.
Ouch. Yes.
So their margins are contracting.
Correct.
And all the analysts are telling everyone about it. So the time to have owned a bank stock and sold a bank stock was last year when they were making ridiculous profits.
Making fat margins.
Now maybe it's time to consider buying. Not that we're advising anybody, but so stocks is it's not it's in here, but we shouldn't give too much weight to it.
Again, these are not equal weighting. The higher up the board you are, the more importance it is to the RBA. Down the bottom, a bit less importance. So current rates, I'll put that in the neutral column. We've already had 350 points of rate hikes. As we were discussing, we're near the terminal rate. It's not a slam dunk that we're going to get more rate hikes. It's a debatable thing, and this is the grey area that our friends at the Reserve Bank will be considering at their board meeting. Have we done enough? That's the $64 question, or do we need just one more? You know, do we need another spoonful of sugar to make it sweet enough, or have we already got enough in there?